Okay, so we've already discussed macroeconomic policy, and just to remind everybody where we are, we mentioned in a previous video the challenges of fiscal policy, and remember this: the idea here is to draw out aggregate demand when we're in a recessionary gap. So here we have output or production that's lower than potential, meaning we have unemployment, and one way we can solve this problem is by expanding the economy. And fiscal policy did this through, for example, government expenditures, which was one opportunity here, or taxes. Now, monetary policy can also help us draw demand forward or pull it back if we're going too far, or contract the economy. But in this case here, we want to expand the economy and move it forward to expand output. So monetary policy is all about the use of money and ways we control the amount of money in the economy to impact indirectly aggregate demand. And so let's take a look and see how that works. First off, we have to have a good understanding of what the central bank is and what it does. So the central bank basically is the organization responsible for conducting monetary policy and ensuring the nation's financial system operates smoothly. That's the role of the central bank. Now, we have a lot of central banking systems across the world today. We have obviously the Fed in the United States, but we also have other types of central banks. In Europe, we have the European Central Bank, the ECB. We have the Bank of Japan, the Bank of England, and there are obviously others out there, but these are the largest central banks that exist. We also have to know that in the United States, we refer to this sometimes as the Federal Reserve. That's the name of it, but it's for short. We'll use the word the Fed to represent the Federal Reserve. So what is the Fed and how does it work? So we'll focus a little bit in this video on the U.S. Federal Reserve as an example. I'll explain later on how the ECB is very similar to the Fed, and yet there's a very unique difference for the ECB than the Fed, and we'll see this. So the Fed is the central bank of the United States. It's composed of a board of governors. These are 7 persons that have been designated by the President of the United States. They serve, each of them serves a 14-year single term in most cases. Their term expires the 31st of January every even-numbered years. They are independent. They're protected from political pressure, and sometimes we even see the President of the United States going against or upset with the Fed. They're very independent, although they hopefully are working together towards improving the economy. They act then independently of Congress. The current chair of the Fed in the United States, and we're in 2020, is Jerome Powell. He is an equal member of the board. He has 1 vote. But, and this is very important, the power that the chairman has is that the chairman or chairperson controls the agenda, what is discussed. And this is an incredible source of power. This person can say, well, today we'll vote on this, or we won't vote on this, and that's their key source of power. So the Fed chairman has the same vote as everybody, but fixes the agenda. Now, the Fed is also composed of regional banks. And there are 12 regional banks in the Fed. As we'll see in the case of Europe, we have the national banks in Europe. Well, the United States is very large, and they have these regional banks. These regional banks support the commercial banks, okay, in their region, and hopefully help the economy in their region. And they advise the board of the Fed, these regional reserve banks. Now, what's interesting about these regional reserve banks is that each of these banks has a board of directors, and they choose a president. And these people are all named by the private sector. So the private sector appointed the president, or appoint the president of these regional reserve banks. So it's interesting that the Fed is composed of, on one side, the elements that are appointed by the President of the United States, very politically, or they're done by politicians. And here we have the private sector side of the Fed that comes out. Now, the Fed, as I said, is divided into 12 regional banks. And these regional banks, there's 12 of them. You see them all here. We have number 12, 11, 10, 9, 8, 7, 6, 1 is over here. Now, if you've ever looked at a $1 bill, you can actually see that this bill has been distributed by one of these regional banks, and their job is to help manage the amount of money that's in circulation. This one was emitted by Reserve Bank 12. So this is the San Francisco office of the Federal Reserve. This is the regional bank of the Federal Reserve in San Francisco, and you can see there's 12 of them. The Federal Reserve seal is here, but the letter L also represents that it came from San Francisco. We have here the seal of the Treasury. This is the seal of the Federal Reserve, and the number here indicates, as well as the code, the bank where it came from. Now, these regional banks existed years ago also to help clear checks. If you wrote a check, for example, imagine you live here in Dallas, you live in your house, and you write a check and you send it to a company that's in San Francisco. Well, the bank first goes through the Dallas branch. It's routed then to San Francisco, and then the monies are transferred between these regional banks. Today, this idea of routing checks around different regional banks is less of a concern. It still exists, but the banking and the monetary system has evolved substantially since then. So, these regional banks obviously then manage the distribution of money. Oh, I wanted to bring out something here very important, or if you're interested in knowing, is that the money is not printed by these regional banks. The amount of money, the money that's actually exists in the U.S. economy is minted or printed by the U.S. Treasury. It's distributed by the regional banks. They don't do any of the printing of the money themselves. So what does the central bank do? Well, first off, it conducts monetary policy. And this is what we'll get to in a few moments, is this idea of saying we're going to control the amount of money in circulation in the economy to either expand or contract aggregate demand to help us manage economic system. This amount of money is currency, and we've spoken about M1 and M2, and we have to moderate the amount of money. Sometimes in the economy we have a high need for money. We need to have more cash circulating in the hands when people are buying a lot of things. And so we often find that during Christmas times, during the holiday season, the amount of money in circulation actually increases. The central bank will expand during the holiday season and then retract the amount of money circulating when we come out of the holiday season. The objective also of the central bank is to promote stability of the financial system. Okay, so we want to make sure that everybody trusts the financial system, that it's stable, that people are not investing money in unsafe investments. And the central bank provides banking services to commercial banks and other depository institutions and the federal government. They are the bank of banks. The Federal Reserve serves as a bank for other banks. They also serve as a bank for the federal government, and of course they process checks. So a bank, a commercial bank here, can borrow money from the Fed via what we call the discount window. They go to the Fed, and a commercial bank can say, I need some money, or I'd like to have some money, and they'll borrow it through a discount window. We call it a discount window because usually the interest rates are discounted. They're lower than what we see in the marketplace. So the Fed has many roles to play. One of these roles, as we mentioned, is banking regulation. This is there to promote stability of the system, obviously. We also have regulations that aim to maintain solvency, to make sure that they have money on hand if people want their money. And that's what we refer to as solvency. This is through required reserves, so banks have to maintain a minimum amount of cash to cover demand deposits. Certain capital requirements, so the net worth, so banks need to maintain a positive net worth. and that's part of the regulation. And also restrictions on the type of investments that banks can undertake. Banks can't just invest in high risk areas, and how banks can invest the cash and the money they have is determined by the Fed. And reserves that are on hand, these required reserves that the Fed will impose, it should be noted that these reserves are not in the bank. So if you go to a bank today, a local bank, and say, let me see your required reserves, they usually don't have them there. These required reserves are held in the bank account at the Fed. As I said, the Fed is the bank for the banks, and the reserves are with the Fed in the Federal Reserve. And these are called federal funds. The federal funds are the money that, if I have a bank here, and this is my bank, and here's my bank, and here's the Fed, okay, and the Fed says, well, you need to maintain, let's say, $100 million in reserves. I'm not going to keep the $100 million over here. I'm going to keep it in a checking account with the Federal Reserve. And if I need it, well, you can send it to me. And so they're called federal funds. Now we do this idea of regulating the system to avoid financial collapse and avoid, in particular, runs on banks. When people run to the bank and say, I want my money. And this almost happened. We saw it coming close to a severe bank run in Greece in 2015 when the financial system started to collapse. And banks shuttered their doors. They shut the doors and told people to go away. How do we ensure? How do we make sure that the bank runs don't happen? Well, there's two ways we can do this. One is that the Federal Reserve, the central bank, serves a role in providing and helping to provide money. And the second is this FDIC, the Federal Deposit Insurance Corporation. So deposits in banks are insured through the banking system to a certain amount of deposits. So if you go to the United States and you have money on deposits, it's insured up to $250,000 per account. And we have the same thing in Europe today, and in European countries. We have a certain limit that's insured. If something happens to the bank, well, we know that we can get a maximum out of the bank if there's a problem. And this provides us with some sense of security. It was established in 1930 in the United States, the FDIC, and since that time, no one's lost any insured deposits in a commercial bank. Now, the Fed also helps avoid bank runs, because imagine, you've got a bank over here and people are running and say, I want my money, I want my money. Well, that bank can turn to the central bank as what we'll call a lender of last resort. So, this is the last chance I've got. Oops. So the lender of last resort is the Fed, and the Fed can provide money to banks when they can't find money elsewhere. And this helps reassure customers. Now, the European Central Bank, as I mentioned, is very much like the Federal Reserve in the United States. It has a board of governors, and it has members that are the governors of the national central banks. This board conducts monetary policy, and it includes the governing council includes the executive board. There are 19 national central banks. They're like the 12 regional reserve banks for the Fed. And the tasks of the European Central Bank, you've got them right here: to define and implement common monetary policy, to conduct foreign exchange operations, so they can buy and sell foreign currency to change the exchange rate. They hold and manage foreign reserves and official reserves, and to promote the smooth operation of payment systems. Now, and this is an important point, the European Central Bank has a very narrow objective, and I've listed this right here. The European Central Bank basically has a primary goal of maintaining price stability, having low inflation, around 2%. Okay, so this is what's called inflation targeting. This is not the case for the Fed. The Fed in the United States looks at inflation. They're concerned about inflation. So yeah, the Fed will say, yeah, I'm interested about inflation. But they're also interested in unemployment. So they'll look at unemployment, they'll look at growth in the economy, and many other things. So the Fed is focused on many economic indicators and making sure the economy is growing appropriately, making sure there's low unemployment, whereas the European Central Bank focuses primarily, if not uniquely, on inflation. So they target inflation. This is called inflation targeting. And this is one of the main differences between the Fed and the European Central Bank.